thank you all for coming today. We've got here today Gary Norden, whose trading career started at the age of 18. Imagine letting an 18-year-old trade your money. I've got a 15-year-old. I barely trust him with a couple of dollars. So Gary was the youngest ever trader at Yamachi Securities in London. He went on to become the senior trader at a number of investment banks in London, as well as trading options as an options market maker and trading bits of LIFFE, trading his own account and other people's money. Now this is somebody that spent their whole career trading and been very successful at it. And I'm going to warn you about Gary, is that he has some opinions on trading that are the complete opposite of what most retail traders understand or think about trading. The stuff that you're getting off the internet forums is very different from what Gary perceives about trading himself, right? And for many of you, he might say a few things that you don't actually want to hear, but I would advise strongly that you consider the source of the information you're hearing today, and you consider the source of all the other information you've gathered so far. So if there's guys there in the room, if you're not making any money trading right now, and you say, oh man, this Gary guy is just full of it, you know, I don't like what he's saying, you might want to consider that Gary's been making money since he was 18. Right, so this is a guy who's making money. We can go through a bunch of questions, but you know, before you start being too hard of him, you know, consider what the information you've already got has actually given you so far. So Gary, are you all okay?
Yeah, can you hear me okay, Peter, everyone?
I can hear you fine. Not sure about everybody else. Yes, yes, yes. Right, so Gary, is there anything you want to say before we start, or should we just get into the questions?
Yeah, not really. I think we'll get into questions. I think, yeah, I think that'll explain a lot. I'll say, look, I'm open to answer pretty much any question, but if obviously people push too much about in-depth about what I do, you know, I'm not going to give everything away for nothing. So there might be a couple of questions I skirt around. Please excuse that.
Yeah, so one of the biggest questions we got on the email is, tell us everything you do. And obviously, yeah, this is too short a session, so tell us everything you do. But what we'll do, let's dive into, there's one area of questions that a lot of people asked for about scalping. So I'm going to fire a few questions at you about scalping. Now, if you send questions in, I'm going to summarize some of the questions. We don't need to go through all of them. So first question about scalping, how should a scalper prepare before the trading sessions? And that one said specifically from trades bond futures, but I think you could go generally. So how do you get ready for a session scalping?
Yeah, sure, good question. And the preparation before you start trading is really important. It's essential. And even when I was at a bank, you know, I wanted my traders in at least an hour before the market opened, and if they didn't, I wouldn't let them trade on the open. That preparation is huge, and it's a bit like, I think being a professional trader is like being a professional sportsman, and no sportsman goes out on the field without warming up, right? And if they did, you can't compete properly. So that whatever you do before the market is essential. If you warm up properly as a sportsman, you've got to get prepared properly as a trader. I have two sets of watch lists that we will look at, macro and micro I call them, which I explain in my book. So a macro watch list is the first thing you're doing is finding out what's happened overnight in any market, general feeling about what's going on around the world. And you should, as a trader, have an understanding and an ability to put that information together. So for example, you see equities are very weak and bonds are bid and gold is bid, you can get an idea of what kind of a day this is. And then obviously you're preparing a little bit later for your contract, but firstly a general idea, what's happening in the world overnight. Anything interesting, anything big, you investigate further. So you're starting to build up a picture of what kind of a day this is. And then the micro watch list is anything related to the thing that you're trading. So you can kick off things. If you're trading bonds, you know, you may not be interested in what's happened to gold overnight. You may be interested in what's happened to oil if it's particularly spiked because of the inflationary relationship. But you go then into your micro watch list and you're preparing for now more to drill down into your market. So if you're trading bonds, you'll be looking more at yield curves, anything that might affect the yield curve and all the nuances there. And again, this is about preparing yourself. What kind of a day am I in for today? Is it going to be volatile? Is it going to be quiet? What kind of volumes were seen in markets overnight? Were they quiet? Were they high? And all this is about preparing yourself so that when you get in to look at the market and you get behind the screen, that this is not a shock to you, that you are prepared and that you already have some idea of how you're going to approach this day. So it's essential. And then after that, it's a process of continual reevaluation to make sure that you're on the right track as you go through the day. But if you just spend 2 or 5 minutes or even 10 minutes, it's not enough before the market. Preparation is really important, particularly if you're trading the open, which is probably the best time of day to trade and one of the most important. You've got to be prepared on the open. If you miss out, you've missed out, and there's only one open every day, so you've got to make the most of it.
Okay, now one of the things you didn't talk about there, which I noticed a lot of the guys in the room will probably be thinking about, what about support and resistance levels that before the day starts? What do you look for in terms of price levels, if anything?
Me personally, I don't care for them anymore. I used to, I suppose from the floor trading experience, there was a while where obviously anyone can get hold of support and resistance levels, but we as professional traders and floor traders, we didn't get them because we wanted to use them in the way that most people use them. For us, they just sort of gave us an idea of where some of the retail stop loss orders would be, either side of the support or resistance levels. So maybe if the market was getting close there, and I'm sure people understand this, that professional traders would hunt to try and get rid of the stops. From a perspective of believing in that support resistance levels, no, I don't really, I have no belief in a support level, resistance level. It's this is probably the first offensive thing I'm going to say. I think it's nonsense. But in terms of knowing that other people trade around there, okay, and professionals like to kick out the weak orders, and generally stop loss orders can be placed, a few ticks either side of there. But the one thing I did miss out, sorry, Peter, was to make sure that you understand what data and news events might be coming out. So if you need to know what's coming out today. So if there's a CPI figure coming out in an hour's time, again, be prepared for that. For most scalpers, they probably won't trade through that. I notice some courses now where they're teaching people to trade through data. Historically, most scalpers don't trade through data. I'm happy with it, but for most scalpers, it's not really their job to do that. But certainly understanding what's coming out and the fact that the market could go quiet a few minutes before and it could go busy during that period is important as well.
Yeah. Okay, got that. So it's more about market state than trying to figure out what's happening ahead of time, right?
Yeah, exactly, yeah.
Okay. Right, so a whole bunch of questions about scalping. There's people asking about how long you stay in a trade, which products are good for scalping and why, and what kind of win rates would you associate with scalping?
Okay, let's go through those and try to remember. It's early in the morning for me, so let me try to remember all those questions.
Yeah.
So how long in the trade? For me and the style that I use, a few seconds. If the trade goes well, should be in and out within a few seconds, even 2 or 3 or 4 seconds, and that's an ideal time. Depending, if the market's a little bit slower, then you might hold it for 20, 30 seconds, and a lot of it depends on how quickly the market's moving. But I try and teach a trading style that what I call trading the moment, right? And a moment in a market is really how often between trades, or maybe between 2 or 3 trades. So for many markets, that's 5 or 10 seconds, you'll get a few trades, and that's the moment. So I want to be in that moment, trade that moment, and then move on to the next one. Generally, if you're holding trades for longer than that, they're probably not good ones, right? The longer you hold a trade, the more likely it is it's not a good trade, which is why you're holding it, and you've got to be asking yourself the question, should I just be getting out of this one? So I like to hold trades for a short period of time. The shorter I can hold a trade, the less likely it is that someone's going to pick me off. The longer I'm in a trade, the more likely it is that some big trade or someone's going to just do something silly and I'm just going to get caught. So I just want to be in and out very quickly without people being able to hurt me or see me. So in terms of which markets, that's really a personal preference. In terms of professional traders that I've known over the years, many of them, most of them that I've known prefer to trade along the bond curve. Personally, I'm different. I like to trade faster markets, so I lead more towards equity indices, which tend to be, you know, a little bit more volatile. In terms of my clients, there's a whole spread, anything from crude to DAX to 30-year US bonds to gold to copper. So you just have to adapt slightly to your market. But it's a personal preference. Some people find the fast markets are just too fast for them, but that's fine. And so you have to come to something that it's at your speed, but also that you understand. I think for retail traders, if they're going to go into the bond curve, which is fine, it's you know, they're great markets, they probably, for many of them, will need to improve on their background knowledge, you know, of yield curves, of what moves the yield curves, of what affects bonds, and that kind of thing. You know, you do need to understand the product before you trade it.
Yeah. Okay. Now, one of the things a lot of people ask is you're quite well known for talking about avoiding the big guys and trading against other retail traders. And people are like, want to know, well, how do I know that I'm trading against a retail trader? Is it when you trade or locations to trade? There's just a lot of questions about, you know, how do I know I'm trading against another retail trader or trading against the big guys?
Yeah, in terms of pre-trade, there are some things that we look for, some types of condition that are better for us in terms of, you know, we can see that there's, you know, these guys are in there at that moment trading. So we're looking for certain types of market conditions during the day. And also trying to be careful of other conditions which are not looking like that. And that takes time for some people to recognize the right times and the wrong times. And secondly, as the trade is filled, you'll know, okay? So as the trade is filled, and of course you can't 100% avoid big traders, but if I'm filled by what was clearly a big order, then that's a trade I really probably don't want. So I'm just going to exit that as quickly as I can. And so as soon as I'm filled, I can recognize that straight away. So, you know, I really am looking for the little guys more and more and more. And as I say, I can't 100% avoid them. But if I am filled by a big guy and the setup isn't what I want, then I know straight away, get out.
Okay. All right. So the next question. Do you think pit traders, you know, the old guys from the pits, have got some advantage over people who've only been exposed to electronic trading?
I think any trader who has worked in the industry and seen the way orders really do come in and out of markets normally, in most markets, should have an edge if they apply it correctly. But as everyone will know, when the markets went screen-based, the pit traders, most of them struggled. And that's really because well, firstly, the original platforms didn't show the market in the way that we see now. Like, you know, with your DOM at Jigsaw, you can see some amazing information. The original platforms didn't do it that way, right? So they had these very simplistic platforms, and they didn't know what to do, so they ended up just using charts. Now, and of course, on the floor, they couldn't use charts at all. All they had on the floor was a pencil, a trading card, and then they could look around at the orders in the pit, and they could look at the screens about what's happening in the world. And they lost sight of that, and they lost sight of the things that were important on the floor. And there are certain things that are important as a trader, certain skills and certain bits of information that are important, and certain things that are not. And most traders that have worked in the industry understand that, and then it's just a case of applying it to the market. And one of the difficulties of that can be that the market is changing. It does change. The way people put orders in changes. The types of people in the market changes. And what you have to do is to continually assess how that's changing and just apply your knowledge to that new setup. And I think this is something that people are not doing at the moment. So I've got a YouTube video which I call Changing Markets, and I discuss this fact of why don't I follow the volume? Because that's on the floor. That was a legitimate technique, was to see around the pit where the big orders were and follow them. So why don't I do that now? And the reason is because the market's changed. And that's really important. So I still use many of the same techniques that a professional trader would use, but that particular thing doesn't work anymore, or to me, and it won't work. And as I say in that video, that in the pit, it's a very different environment. If the guy standing next to me it's I don't know, Goldman Sachs, and he's saying he's 15 bid on 500, he is 15 bid on 500, right? He can't pull that, and if he does, he's not going to be here very long. So, and if he really wants to buy a 5,000, I'll figure that out pretty quickly. So a different environment. Also, I can follow that. And if I know that, for example, a certain bank is buying bunds, it doesn't take many phone calls to find out that something happened in the OTC bond market, for example, or in the OTC options market. And yes, that's what he's doing. You can put the trade together. You understand what's going on. Now we don't know who trades, why they're doing it, what's going on. So why am I following? What am I trying to follow? So continually trying to work out, and there's a lot of discussion. I'm talking with some of my network at the moment about, I think a number of us have been almost blindsided by some quite major changes to markets, subtle changes that have been happening, and I think now we're only just sort of catching up with some major changes in markets. So you just got to keep doing that, and once you work that out, it's like, okay, then what does this mean for me? I tweeted one this morning, a really good research paper that is about something I've been talking about on Twitter for a couple of days now, to do with VIX and options for anyone who's an options trader. Really interesting to look at, because it's showing a complete change in the market, the way the market works.
Yeah, that's interesting. And I would what's your Twitter feed, just out of interest?
So Gary_Norden.
Gary_Norden. Okay, we'll take a look at that. Right, is there any general characteristic, which separates good traders from bad ones?
More profits, less losses. Less big losses, that's for sure. The ability to cut a loss is, if you can't cut a loss quickly, you're never going to make it. Doesn't matter how many profits you have, if you run losses, you're stuffed. It's just not going to happen for you. In terms of personality traits, you've got to be a hard worker. I'm a big person who believes in humility for everybody. I think if you ever get ahead of yourself, this market will take away from you. It is hard. I know that banks run psychometric tests, and prop shops do, and I've worked at investment banks that ran these psychometric tests on our new graduate trainees, and I can tell you I didn't see any improvement. I like, to me, one of the great things that sums up a trader, or the great stories, was in Nassim Taleb's book, not Full Baron, it was the second one, The Black Swan.
Yeah.
He tells a story of the streetwise guy, I think he calls him Fat Tony, and the nerdy guy. And he says, if you tell them both that you've got a coin and it's, head and a tail, and you flipped it 999 times and it's come up heads every time, what are the odds of coming up heads or tails on the 1000th? He says the nerdy guy will tell you, well, it's still 50-50, doesn't matter before. And Fat Tony will just say, don't trust that coin, there's something dodgy about it. I think traders need to be like Fat Tony. I think you have to understand that there's math behind it, but at the same time you have to understand it's not just math. Okay, there's people, there's manipulation, there's all sorts of other things happening. You've got to have that little bit of nous that says to you, a streetwiseness that says something might be up here, in which case whatever your trading plan is or whatever you think you're doing, if there's something that tells you this might not be right, get out.
Yeah.
It's that thing that when you're sitting on a subway train late at night and you don't even have to look at the person that might be on the other end of the carriage, but you've got a feeling that something isn't right, you get up and you walk out. You don't leave yourself. Some people don't have that thing as well, particularly if you're not brought up in the city. So, I think that's important. And, in my life, growing up as a kid, as a teenager, I used to go down to a greyhound racing track, and I used to come from East London. And from about 15, 16, I'd go to a greyhound track. Now, it's a very interesting business, trying to make money betting on that industry. But what it told me was an awareness that some things aren't right, and to start to pick up on this. And I reckon that really helped me as a trader.
Yeah, that's cool. That's cool.
There's a lot of things in this business that just don't look right sometimes, so you just got to react to it.
Absolutely, absolutely. Right, so next one, do you think keeping track of options open interest at various strike prices is important when you're trading futures? And if so, could you elucidate?
There used to be, and even going back, going back to the floor days, there used to be a rule of thumb that coming towards expiry, that the underlying or the futures market might move towards the options open interest or the options strike with the largest open interest. That was just a rule of thumb, and we're not talking about the ones at extreme. So if there's a deep out of the money put or deep out of the money call with a huge open interest, which can happen, we're not talking about it going there. We're just talking around about the at the money strikes. There might be 3 or 4 or 5 at the money strikes. That was a rule of thumb. I tend not to think that anymore. And option markets are changing a lot. And again, going back to that Twitter feed that I talked about the VIX, there are significant changes, I think, in options markets. So I think it's something interesting to look at if you're trading futures, to look at what the open interest and what the options are doing, but don't build a trading plan around it.
Okay. It's just another piece of information, right?
Yeah, exactly.
Okay, what are your thoughts and experience on spread trading?
I'm not a spread trader. I haven't ever done it. It's obviously very popular within prop shops for a number of reasons. Look, I like it. I think skilled spread traders are very skilled traders. And there's a couple of guys, at the Online Finance Academy who I'm working with. I mean, Mark Schleys has been doing it for 30 years. He's one of the guys that sort of almost the originators of spread trading. And I've got a lot of respect for the skilled spread traders. Obviously, you're going to need to have very low commissions. There's a lot of scratching in spread trading. And of course you've got 2 legs. So, skilled spreaders, it's again, a low risk, skilled spread traders, are good traders. It works in probably the prop room environment in a better way because they're accessing cheaper commissions. But now, there are some good brokers offering all-in, monthly fees that cover all your commissions. So that kind of thing works well. So yeah, skillful, those who can do it. I think I don't disagree with it. I think it's a good way to trade.
Okay. Now this is an interesting one because it's something we talked about I think just before Christmas. What does it take to succeed at trading or arbitraging volatility? And what are the tools of the trade? I think you can go short term or long term on this one.
So trading volatility, I take it that's meaning trading options or volatility arbitrage.
Yeah, he talks about arbitrage and volatility. Yeah.
Yeah. That's probably one of my favorite strategies, volatility arbitrage. Obviously, it's not future scalping. So for those that are not aware, you can use options to trade the volatility of an underlying market. So you set up a position which it doesn't matter which way the market goes as long as it goes. As long as it moves, you make money. You're trying to find, obviously, buy options when they're cheap. If you buy options and the market doesn't move, like the last few months for most of the time, you're not going to have many re-hedge opportunities because the market isn't moving. You're probably going to be losing money as an options, as a volatility arbitrager. But as a style of trading, I think it's an excellent style of trading. And similar in that respect to the type of scalping that I want to do is that I'm trying to choose trading methods which are not about prediction. And I think that's probably the biggest fallacy in retail trading, is that trading is about prediction and forecast. That your job is to try and predict where this market's going, whether it's next week, next month, or in half an hour's time. To become a professional, it's more like, as I talk about in the book, about being a bookmaker. Not about predicting, but getting in and out of what everybody else is doing, knowing that most of those people are going to lose. And volatility arbitrage is like that. If most retail options traders will probably sell options as well, and they'll sell calls, they'll sell puts, and they hope the market goes the other way. Volatility arbitrage is saying, I don't know which way the market's going. I'm not trying to pick forecasting tools. I just think it's going to move. And that's why if you look at professional option traders, like floor traders, like I was an options floor trader, or professional option desks, they are all volatility arbitrage. Market makers will set up a volatility arbitrage because they have to hold positions, so they'll trade it in that way. Small, try to be delta neutral every day, so market direction neutral. Obviously, volatility arbitrage, hedge funds, very popular. Convertible bond, hedge funds, a volatility arbitrage. Most people that are trading derivatives professionally, in my opinion, and that I've met, will trade volatility arbitrage, not direction. So as I say, if you can get away from trading direction and start to trade the other ways, it's more interesting, they're less risky, and more professional in nature.
Yeah, that's cool. This is a good one. I like this one because somebody's talking about fake news, which is a big sort of into politics now. It's not really fake news, but how do you know which news is really going to affect the market?
There's two sides to that. How do you know which news is going to affect the market, and how do you know to what degree it's going to affect it as well? And that's important. Magnitude is important when we're looking. It's not easy. Sometimes, obviously, I was having a discussion on Twitter yesterday with quite a well-known strategist or analyst here in Australia about some of this, and I was trying to tell him to embrace the randomness. So some news we know is coming out, CPI, and this has the potential, and that's what you have to say to yourself. It has the potential to move the market. It doesn't mean it will, and it depends on a number of things. One is how big that number is. So, you know, the numbers like PPI, CPI, unemployment rates sometimes, you know, if you're trading oil, then inventories, you know the data that could affect, and it has that potential to affect. Why would it affect you? Well, a lot depends on how your market's positioned. And again, I explain this a lot in my book. People think about the belief that markets are ahead, in my opinion, is completely incorrect. The way to approach markets is to say that they price in something. So if your market is pricing in something in particular, then of course you have to look at the data and think, what happens if the data conflicts with what the market thinks? Then it can have a big move the other way. What happens if the data agrees with what the market thinks? Then the market might, you know, meh, or it might go up a little bit, might be a little bit small, who knows, but it'll be small. So that's really the challenge, and that's what you need to be working out with data. And then obviously there's that the randomness of other things hitting that we don't know about. So yesterday in our time here in Asia, the Moody's downgraded China, which affected a number of things, particularly Australian stocks, Australian dollar, which fell as a result of that. Now you didn't know that was coming, right? But again, if the Australian dollar had been firm, which it had been for a couple of days, and that news comes out, that's going to wipe out all those new longs.
Yeah.
So the data itself has, you know, any data has the potential to move a market, and that's important because, and again, there's a, I've put on Twitter yesterday this conversation, and have a look at these two charts. If you want, I don't know if I got any questions about charting and my dislike of charts.
Not yet, not yet. I think they're warned off.
They're warned off, but I put, yesterday on Twitter, I put basically two charts that were sent within a couple of days of each other by a chartist, and to me it just sums up everything about why and how people use and misuse charts, and why I don't want to touch them. And it comes again back to this about how markets work. And so say go on Twitter, have a look, but the chart is of the Australian dollar, and 2 or 3 days ago it was trading up, and this chartist had drawn some lines that showed it had broken out of these two lines that he'd drawn, and he goes, go on the Aussie or something like that. It's Aussie's going up. Yeah, okay. And then yesterday, because the Aussie had a really bad day, he's drawn some different lines and now shown that the Aussie is trading at the lower end of these new lines, and it's actually in this little band, this little range, or a channel, and it's at the bottom of the channel. And I'm like, hold on a sec, 2 days ago it had been breaking up, and he said, oh no, but it reversed from that one, and I explained it, but my point was the fact that he's drawn different lines to explain the rally, and now that the rally petered out, he's drawn different lines to explain the fall. And I said, well, actually, why don't you just embrace what really happened? Okay, the US dollar had been weak and the Aussie had been rallying, like other currencies. And then there was a downgrade of China, of their credit rating, which affects Australia. Australia is, I'm sure most of your listeners know, is hugely in with China. So that downgrade affected anything Australian. So at that moment, the downgrade came out, wham, Aussie dollar is going to fall. the price at which it fell from is pretty much irrelevant.
Yeah.
Whatever it was at that time, it was going to fall, having been rallying for the last, day or two. The market didn't fall because it was at the top end of that channel. It didn't fall because it was rejecting that level. It fell because this news came out, and it just embraced the randomness that the price that it fell from was the price that it was at that time. The problem is, and this is where people misuse charts again in the future, is that in 3 weeks' time, 4 weeks' time, people have forgotten about that, which day and what happened there. So when the market goes back to that level, they go back, this is where you get support and resistance levels. They think that's a resistance level where it came back from on that day, or it came back from that level. Well, no, it didn't actually. It reacted to news. If you still use that level in 3 or 4 weeks' time, you're kind of making the wrong conclusion to what happened.
Yeah. So you're saying it didn't bounce off the line?
No, because the line was only drawn after it fell. That was the other classic thing. His channel could only have been drawn after this reversal day. So there's more hindsight in what he. I mean, and I had an offline messaging with him as well. So I'm not being personal, but this just doesn't make any sense. You could only draw those lines after the reversal. So don't tell me that it didn't break out. Oh, it didn't break out of the trend line. Well, you could only have drawn it afterwards. So of course it can't break out of something that you've drawn after it's moved. So again, quite a funny exchange, I think it was anyway. And to me, it just summed up again how people misuse these charts. The chart tells everything.
And how you abuse people's entire careers in technical analysis as well.
How I make friends.
Yeah, how you make friends, Gary. Right, we've got a couple of more questions about scalping. Some people asking whether you stop and limit orders, and people asking how many ticks. I'm going to throw in a question, right? How does because it'll come after how many ticks. How does a scalper move from taking a tick on every trade to letting trades run?
Right. So, how much do we make? I try to say, like, I trade the moment. What I try and say is I get whatever the market gives. So I actually am not trying to run trades for very long. I would rather get in and out, in and out, in and out 3 times, even though that adds commissions. To me, that's less risk than running a trade and try and making more. So what I say is I'll take whatever the market gives me at that moment. So if I'm trading a market that moves 1 tick at a time, I'm probably trading it for 1 tick at a time. If I'm trading a market that moves 3 or 4 ticks at a time, that's what I'm taking. Sometimes you'll get on something and it's really good and it jumps 6, well, you'll take the 6, whatever's there. And in that situation, don't be greedy, just take whatever it gives you. But as I say, I trade that moment, so I want to trade what that moment gives me, because that moment can reverse and change straight away. And that's the thing, with this is that suddenly you're 5 ticks on side, beautiful. You hold out for 6, you get 3 or 2 or 1. So I don't have predetermined targets. I get whatever it gives me at that moment. If that entry is good, whatever it gives me at that moment is what I'm looking for. So minimum of 1 and going up. In terms of do I use limit orders? Yes, absolutely. All my orders are limit orders. And in terms of stop loss orders, I don't use a hard stop loss order, but basically as soon as I'm filled, I kind of know whether this is a right trade or wrong trade. If I don't like the setup, I will probably look to exit straight away, which will be a scratch or maybe a 1 tick loss. Sometimes you'll get filled and it's wrong and you'll take 2. I mean, I'll take that. It's going to happen, but so that's the scenario. Whatever it gives you at that moment is what you take. I don't know, and that's how the whole approach to my scalping is. I don't know where it's going to be in 10 minutes time. But I know what it's worth right now, and I know that I can take this right now.
Okay, that's cool. Right, so a couple of questions from Andre and Mike is, one's asking, how do professionals use order flow, including, games played, pulling orders, and do you put any value on reading the resting orders, the bids and offers?
Reading order flow, I think, is one of those things that you have to continually adjust to what's happening in the market and how the market is changing. So if you think about the early days, like when I was first doing it, the icebergs didn't exist in the early days. You weren't interested in them. Then they come in, you kind of have to learn what these things are, and you'll learn a little bit about how they work. But then after a few years, really, you should forget icebergs. And, I'm sure most of us stopped looking at them quite a while ago. So you're looking at order flow, and you're probably looking at a number of different things. And I know, like, you know, Peter, with your platform, you can see what's coming in and coming out, and that it can be important. You still have to learn the context as well. Orders coming in, bids coming in, or offers dropping out, or whatever. It can be important. It might not be important, right? As part of the market, the bids come in and out all the time. What's the context of it? What's happening around? And that might tell you a bit more. In terms of, so what was the second part of the question?
You know, how much attention do you pay to the bids and offers?
Yeah, we do. You are looking around at the bids and offers. Even though I'm trading around the actual bid and offer, so that's the most important thing, particularly when you're trading thinner contracts. I think if you're trading bonds, you're not really interested too much in what's 6 ticks or 8 ticks below and above, particularly not for the way I trade, because it's probably not going to get there in the next moment, you know. But if you're trading crude oil or DAX, then yes, the market can be 6 ticks higher in the next moment. So I am more interested in that to some degree, but knowing that a lot of that, you know, is fake. If you're trading in equity indices, there's a lot of orders that are 6, 7 ticks away, which are basically just arbitrage orders, just in case the market moves there and the underlying hasn't moved. Or, you know, with oil, a bit different, but you still have to be a little bit more aware of what's going on around you. But knowing that, yeah, there's a lot of fake stuff, particularly in crude, isn't there? I mean, orders get pulled all the time.
Sure.
And also the liquidity might only look like 5s and 10s on crude oil, but it's probably a lot thicker than that because of a number of things. And that's, again, to do with market changes. Crude oil is another interesting one where I think the market has changed dramatically in the last few years, probably the last 2 years, 3 years in particular. And I think you have to really look as a trader at that market. Remember that when you look at a market on a chart, it always looks the same, right? The crude oil market, any market looks the same as it looked 20 years ago on a chart, but it isn't. On an order flow basis, you'll probably pick up on some changes, and that's one of the good things about using order flow, is that you will pick up on some subtle differences that from, let's say, 2 or 3 years ago. Well, it's looking a bit different now. And when you start to pick up on that, that's when you, if you want to become more of a professional trader, should ask yourself, okay, I'm seeing, it's feeling different. Okay, it's seeming different. There's more volume than there used to be. And we know that open interest and volume on crude oil is increasing all the time. Why? You know, you need to start looking at why, what's going on. And once you do that, you start to figure out that there's more things going on in this market than there used to be. And then you can start to, you know, again, maybe change your approach, or maybe certainly what you should be doing in that situation is adding things to your watch list that may be influencing that.
Okay, that's good. Right, so we got one from Phil. Hi Phil, long-time customer. Do you trade into value or away from it, or do you ignore it completely?
Value is a really interesting word. So my sense of value and what I use as value is going to be, I'm expecting, very different to what Phil or other people say is value. So value is very important to us as a market maker. So my style is a market maker style. Value is very important to me, but value is not anything to do with volume profile, market profile. Okay, so value is important to me. I can assess value right now at this moment, and what I'm trying to do is trade either side to it. So if I think value is 16, I'm either trying to buy 15s or sell 17s, because there's a tick of edge in doing that. So that's what I'm trying to do. In sense of what value is, there's about 4 or 5 inputs, and you know that goes to the core of what I do. So I'm not going to explain that here, but yeah, I'll work out value, but it's not to do with volume or market profile. Okay. I'm not interested in what happened half an hour ago, 20 minutes ago, 30 minutes ago. That's not the way I trade.
Yeah, okay, that's good. Okay, there's some people having a problem with the sound. Guys, that's you, because it's fine here, and I'm in Thailand, and it's terrible internet here. But there will be recording afterwards. Next question from Laszlo. Laszlo, congratulations. I heard from your boss that you're about to get funded. If your boss didn't tell you about that yet, there you go. Laszlo's at a prop firm, and so he's just about to go live, I think. How do big traders put their orders on nowadays? Is there a way that we can recognize that?
The reality is that If you're interested in big traders, there's a whole heap of different things that they do. You know, and having been a large trader and taught at banks, that's one of the reasons why I'm not really interested in trying to figure out what they do. And everyone's got different techniques that they use. When I teach clients, I talk about some of my techniques that I would have done. Essentially, more and more, and again, on the floor, this wasn't the case. On an OTC market, if you're dealing bank to bank, hedge fund to bank, hedge fund to hedge fund, or whatever, you know, you're quite straightforward. But now on screens, you can be a little bit more sly, and it kind of reminds me a bit like I like playing poker, and I think a lot of traders do. In poker, one of the aims when you're betting is to look weak when you're strong and to look strong when you're weak, right? So when you're bluffing, you don't want to look like you're bluffing. You want to look like you're strong, otherwise people know. But when you've got a really strong hand, you don't want people to know you've got a very strong hand. You want people to think you're weak so that they'll bet with you. And there's a lot more of that now. So people are buying when they're really selling and selling when they're really buying. You know, and you can't be surprised at that somebody, if they've got a really big order, let's say to buy 10, 15,000 bonds, they might buy 30,000 and sell 20 if they think they're going to struggle to buy their 10,000 without moving the market. Yeah. If you have to buy them and you think you're going to move the market on that day, you're going to have to think of a lot of different things in order not to hurt that. Yeah. Bearing in mind that it's very likely that you may have instigated your trade. Let's say it's related to an OTC bond trade. It may have happened before the market opened. A lot of big business happens at that time before the market or on the open. Somebody's asked for a huge trade. You've done it because you're working in a bank. You've now got to buy, let's say, 10,000 futures, and you know that you've only got a small leeway to get them to be profitable. You know, you're going to work out a number of different strategies for doing that. Mm-hmm. As I say, I mean, I only know what I know and what I've seen other big traders do. There's just dozens of different techniques of getting in and out. There's different techniques for entering big trades as well, and there is to exiting. And on the exit, it's very much dependent about, really, is it a profitable trade or not? If you're taking an outright position, so it's not a hedge for an OTC trade. If it's an outright position, if you've made money, you can be quite relaxed on the exit. If you've lost money, you're probably going to be a little bit more forced on the exit. So again, when you're looking at big volume, that's important. If you can even trace that there's a big seller here, if he's exiting a trade and he's a loser, you're going to want to follow him? Yeah. Probably not.
Okay, so next question. It's an interesting one, this is. So, and it's probably one that a lot of people are thinking. If you're not predicting the market, how do you know whether to go long or short?
Yeah, so a couple of things. The value that I'm talking about, so when I say value, there's 4 or 5 inputs, and 2 or 3 of those, or 2 of those, will tell you which way you want to be. So you're looking around at various different bits of information, and you're putting them together and saying, yeah, okay, I want to be long here. But remember that I'm only trading around the spread, so saying I'm going long, you know, I'm really just, you know, trading around the spread at the time. So but there's, it's hard to explain, but it's one, you know, a couple of inputs. You've got to look around you, look at what's happening around you, as well as what's happening in your contract. Put together, you know, a few bits of information and say, okay, then I think the market's worth 16, and there's a chance of me buying 15s. I'm going to, you know, buy 15s. Yeah. Sorry, it's hard to explain because I'm getting to the nub of exactly, you know, what we do, and that's hard to explain without explaining everything. Yeah.
Okay, so Laszlo again, yes to the question. What percentage of your orders get filled? Would you say?
Yeah, it's a good question. It depends
entry orders, I presume.
Yeah, entry orders. Okay, it depends on the market you're trading, how fast it is. Generally speaking, the faster the market you trade, you'll tend to put more orders in, but you'll pull more orders as well. Because there's more things happening, right? So there's more opportunities, but you don't always get filled. And then following on from that, basically, you know, some days there's just more business, there's more two-way business that will get you filled. So some days I could put 100 orders in and get filled in 50. Some days I'll put 100 orders in and get filled in 30. But the faster the market you trade, if you trade something like DAX or FTSE or ES in America, something that's fast, you will end up pulling, you know, more orders. So basically, I want to get filled now, and if I'm not, then I'll cancel that order. So yeah, I'm quite relaxed to cancel a lot of orders. Essentially, I'm throwing my fishing rod in. I'm trying to fish. I'm trying to catch someone. If I don't get it, okay, I'll put it out again, so that I'm not caught. The longer my order's there, the more likely I am to get caught. So I don't want that.
Yeah. Right. I've got a great question from Cheta, and it comes. The first part of the question is a statement, and you're probably going to disagree with it. And this is where you upset people. So the higher win. I'll just read it verbatim. The higher win rate comes with more risk mathematically. You can't have both. How do you avoid the one loss that wipes out your 10 wins?
By cutting it straight away for a tick. I don't.
Well, he's saying that basically.
I don't see why, because I have a high win rate, that I have to have a big loss on the other side. I think that's generally what a lot of retail traders are like. Their losses are big, but it doesn't mean that because I'm making a couple, that the loss has to be 10 or 15. I don't agree with that at all. There's no reason why it has to be big. If I realize, firstly, I have to, you have to know the market conditions. So as long as I'm trading in the right conditions, I've got a fair chance. If I know my market, I've got a good knowledge. One of the things that I do and that I teach people is to understand as soon as you're filled whether that entry was good or not. And if it isn't, just get out. Now, if you're trading bonds and you recognize as soon as you're filled it's not a good trade, I don't see how you're going to be losing 5 ticks unless you ran into a really big order and it smashed down 5 ticks. In which case, if that's happening every day, as I say to my clients, if that happens to you once a day, you're getting something wrong. If that happens to you once every 3 months, we'll cope with it. Yeah. But I don't necessarily see why, because I'm making a high percentage win rate, that my losses have to be big. That's not math. Sorry. Okay. So let me kind of delve into that a little bit, because it's a common misconception. So there's a lot of people that believe that to get a higher win rate you need to risk more, and a little bit confused as to why scalping has a higher win rate. So Gary, why would you say it is that scalping has a higher win rate, and why it needs to have a higher win rate? Yep, so it has a higher win rate because you're picking off poorly placed orders, and there are loads of them. So if you think about the people that we want to trade against, the small players, they really don't know how to place orders correctly. And if I think about the inputs that go into my measurement of value as a market maker, they're way beyond what retail traders understand about markets. So I have to think I have edge over them. I have to think, and I have to know that I have edge over them, the way they place their orders. And particularly at certain times, there's certain times where I almost know that they're going to get their orders wrong. And in fast markets, they're going to get their orders wrong. So once I know that, and I can start to anticipate they're going to make these orders wrong, I can pick them off. And as long as there's lots of them, we should be okay. So that's why it has a higher win rate, because the people we're trying to trade against are really poor. They're really bad traders, and they don't understand what the value is right now, because they're not looking at that way. They're looking at their chart, or they've got their longer term view, and they don't know how to put orders in. We have better platforms, right? We're using DOMs like you've got, where we can trade, and some of those are using all different types of platforms. So that's why it is. And the first thing when I sit down with traders to teach them what I'm doing, the first thing we do is to specifically identify who do we want to trade against and why. What is our niche? And I say that to all traders. If you're going out there, why do you think you're going to succeed in a business where, I heard there's a new book out from a professor in England, and in his studies of trading, he found some which said that there was only, I think it was a 1.8% success rate in some of the people he went to. 1.8% success rate. It's a 50-50 business, for crying out loud. And there's well over 90% of people losing. And so you've got to ask yourself the first question: why am I going to be this small group that's going to make? and you've got to start to identify why is specifically, where is your edge? And if you think your edge is because your predictive indicator is better than someone else's, it's probably not, right? It's probably been tried a million times before. So what I do is sit down with people and say specifically, who do we have edge over and why? And we outline the areas we have edge, the reasons, the times, and then everything about what we do as a scalper and what I do and what I teach is then based on that.
Yeah.
I've identified that. That's my business model. That's what I have to try and take. And luckily, you know, these people are still around.
Yeah. Okay. Right. So again, I think you already talked about you trade thin markets. People ask you specifically what markets you like to trade, and what sort of liquidity, you know, size of liquidity do you like to trade around?
Yeah, so first question, like I said, I prefer equity indices, FTSE, a little bit DAX. I've not got a great history on the DAX, but I'm all right at it. I've tried other markets, gold, oil. I'm reasonably pretty happy with that, but I prefer equity indices, so I always come back to those. Liquidity is an interesting question. I've written about this. Retail traders seem to be really interested in liquidity. And FX providers, and I'm really not a fan of that FX business, but they go out and talk about what you're trading the biggest liquid market in the world, it's worth trillions. And I'm like, well, you're trading one lot. Who cares if it's a $1 trillion market? If you're trading 10 grand in FX, why do you care it's a $1 trillion market? That's the least of your worries. Yeah. And so, for me, if you're trading a thin market, whether it's crude or DAX or something with we've only got 10 or 15 lots on the bid and offer, or gold sometimes. Basically, you're not going to trade more than probably 2 lots in those markets anyway. Yeah. So liquidity, as long as I can get in and out of 2 lots, it's fine. And if there's only 1 lot or 2 lots on the bid and offer, I'm either not going to trade or only trade 1 lot. So you adjust your volume according to the market. So in terms of liquidity, I'm not, it's not a factor for me. I'm a small trader. If you're trading bonds, which is a bit slower, you're not going to trade as often as you was if you were going to trade DAX. So DAX, I could trade 30 trades an hour in the DAX, probably quite comfortably. If you're trading bonds, you won't get that many opportunities. You might trade 3, 4, 5 times an hour, but you can scale with the bonds, right? And it's a bit slower. So you can scale to 5 lots or 10 lots or more if you're good and you hit high percentages. And to me, you only scale if you hit high percentages. So liquidity, I'll adjust accordingly, but it's not the biggest thing in my mind. Okay.
We'll go through a couple more questions if you're okay, Gary. We're nearly at an hour, so sure. Are you still? Are you caffeinated?
Yeah. If I did have a cup of tea.
Very
right. English of me. Sorry.
Yeah, there's no caffeine in tea. Right, an interesting question. Do investment banks and hedge funds tend to use more limit orders or market orders? And I'll throw in a little bit on top of that. Is that we do see a lot of size on the market order side throughout the day. If you're trading the S&P, there's 100 lots going through all the time. And and what's your opinion on who's throwing that big size in on the market orders, and how does that tie in with what investment banks, hedge funds, and other institutions that you've worked with do?
Yeah, it's a really good question, and a lot depends on what the style of business it is. So, for example, if it's hedge related. And that can even come from the options market, okay? So there could be trades going through the options market. Option market maker just sold 500 call options at the money. He has to buy 250 futures. He's just going to put that in straight away, right? Because he's priced it around where the market's trading now. Option market makers are not ones willing to run and try and hold or try and they'll just put that in around about now and probably put it in as a market order. And that could be, as I say, 250 lots to hedge a 500 lot option trade. Hedge funds, in my experience with the markets that I've traded, tend to be quite specific about where they want to get filled. So they tend to be more of limit orders. Pension funds, mutual funds, so your long-term investors in stocks and that kind of thing, tend to either be VWAP or they don't care. So they're either VWAP or they'll just take whatever the price is. So that's And that, to me, that's a failing of them, and why we love trading against them, because they kind of they don't care where they get filled, and I find that wrong. To me as a trader, I always care where I get filled. Investment bank traders, depending on what they are in the investment bank, do normally like to have some kind of a limit to what they're doing. You know, they want, you know, they don't want to give away too much, and market orders are giving away edge. No matter what way you think about it, they do give away edge. You also, and I would just say, start looking at the wider universe. There's new players in these markets right now. There's new big players in these markets right now, and I suspect they are the source of much of this volume that's coming through as market orders.
Yeah. Just a couple more. Somebody's asking if this is your high school picture that we can see on the screen.
That's a floor, so that's my badge on the life floor, and my mnemonic. So every time someone traded with me, they traded with Uzi, not my name, but that picture, I don't know what happened to the hair. I never had hair like that, not that I can remember. The computer pixels, you know, old computers, their pixels went a bit out of control. I was probably 20.
To the extent they gave you a new hairstyle?
Yeah.
Okay, you say so.
I was probably 21, 22, 23 when that picture was taken.
Yeah, that's cool. One more thing, is there any reason you don't automate your scalping?
I'm a control freak. I love to be. No, it's very small. Some of my clients do automate the exits, and that's fair enough. So some people I teach, yeah, they do automate the exits, but the entries, because you're just trying to test something, it's a little bit harder to automate the entries. Exits can be automated. I just choose not to. It's like taking them.
Okay. And I think on that we've done an hour, and I would like to say thank you, Gary. That's really good. A lot of good information there. So thanks for that. Is there anything you'd like to add before we close out?
No, I'd like to thank you, Peter, for continuing what you do. I think you do a great service to traders everywhere, both with the platform and with the sessions that you do. And thanks for having me on. Thanks to everyone for listening. I hope I didn't offend too many people. And just, yeah, I wish everybody good luck.
Yeah, so thank you, Gary, and thanks everyone for attending. There will be a recording. I will send it out later on today. And like I say, Gary, thanks a lot. It's nice to speak to you again. We've been for a beer before. I hope we can do that again.
Definitely.
Enjoy the rest of your day.
Thanks, you too. See you, everyone.